Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome back to another exciting episode of the What Matters podcast. I'm Mike Mershazadeh.
And I'm Ashley Ward.
Today, we're honored to have a special guest joining us, Gary Hirschberg, founder and CEO of Aaron Wealth Advisors in Chicago, Illinois.
Gary, with your extensive experience in wealth management and your unique journey from nonprofit development to founding Aaron Wealth, we're very excited to have you with us today and hear some of your insights in the industry. Thanks so much for joining us.
Appreciate it. Good to you.
Well, let's dive right in. So, Gary, let's start by exploring your journey into wealth management. Can you share with us your origin story and the experiences that led you from starting in nonprofit development to establishing Aaron Wealth Advisors?
Yeah, there's a lot of life in between that, one or the other. But, I was very fortunate as I went to Georgetown undergrad. And then my real first professional job was in nonprofit fundraising at Georgetown. And I learned a lot during that time frame about how you deal with families, significant families, and helping them think about their giving gifts in a selfless way, right? And I was like, but still, same type of families we now serve today. Later, ended up going to Vanderbilt for my JD MBA. They also engaged me to raise money. So I was doing both studies in that for a subsidiary of the firm, of the university. And, enjoyed it. Didn't know what I was going to do with my life, but JD MBA is 4 years and figure it out, but not surprising. One of the folks I was asking for a nice gift, ended up not returning my phone calls for 7 months. I was director of development or whatever, and he was a partner at Goldman Sachs at the time. And ironically, and serendipitously, I met him in a waiting room at Vanderbilt. That was the next meeting over, and I walked out, gave him an elevator pitch, asked him for a good gift, and said, see ya. Didn't think anything of it. A week later, he called me up and said, look, I don't want to talk about the gift. And for the record, they were very generous, him and his wife, both Vanderbilt grads. But he said, have you ever heard of Goldman Sachs? And then, of course, like small firm. I was like, but then he recruited me specifically to go to private wealth management at the time. And at that time, the industry was really changing away from securities to, at least trying to, away from securities and product to more advisory, right? So they were looking for people with my training. So JD MBA particularly was attractive because it had both sides of the equation. But I would have been an estate planner probably. I got on the legal side or started a business somewhere on the MBA side. So I wasn't quite sure how that would mix, but Goldman solved that problem for me. In 2006, I started full time. Took the bar, and then 5 days later, went to training. And then after that, was there for almost 15 years. Lots of saw the up, saw the down for sure. Saw a lot of other things. And I was like, but during that time frame, great experience. But by 2018, it was time to 39 years old, time to make a different decision. Nice book of business, great relationships, and I just saw a lot of potential in the independent side. Some changes in the industry and the banks and what they were focused on. And said, when am I going to take the MBA side of my risk? Right? Start my business. So I left. And then since then, now it's been 6 years later, it's been history and, best decision I ever made.
Wow. So talk to us about that. So you were at Goldman Sachs for what, 12 years almost?
Yeah, 12, 13 years. Yeah, something like that.
And, you started your own company, 2018. You guys have gotten, correct me if I'm wrong, to about $2 billion in AUM. If I'm not mistaken there.
Regulatory AUM, right.
Yeah. Talk to us about that growth. How'd you guys get there? Did you build it all organically, inorganically?
For the last 6 years, that's been mostly organically. I was very fortunate that a lot of the relationships that I built followed and understood what I was trying to do, which was to build an ability in an independent way to offer them a single family office experience without having to pay that price. And they were, especially the early relationships, which I still am very appreciative of them, to be able to customize to them, each one of them. And along the way, got to hire some really amazing people. That message then got out to the broader world. I can't tell you how many clients ended up becoming clients because they knew me before, but had never hired me while I was in a captive product environment. And they told me so. They said, now you're independent, different story. And then, started engaging them, able to provide all kinds of services. So it's been actually exceeded my expectations. We should, be, I believe, at about $4.5 billion by the middle of next year. And that's just organic and not expected. That's assets under advisement. Of course, we refer to our ADV any day of the week, and that's to our regulatory assets and management as well as advisement. But that's my projection.
Wow.
So let me ask you this. How many total advisors do you guys have now?
So we have 4 in total. We have 60 employees, 3 offices. So you have an office in Newport Beach, office in Carmel, Indiana, which is outside of Indianapolis, our most recent open. Mix of advisors, business development, client service, investment professionals, etc. We have an investment division. We have specifically, separated from the advisory. That was something I wanted to do from the very beginning, to preserve the due diligence that we do on behalf of our clients. It's not affected by the relationships perhaps we have on the advisory side, client service, and then of course operations. I hired Dynasty in the very beginning to help kind of offset some of the load in the beginning, in terms of when you ever transition. I had at least a lot of that taken care of, and still today they help offset what I would need to hire myself and a better value proposition, in my opinion. But at this point, it's a really great partnership. And I was like, but we have 60 employees. Yeah.
Did you say 16 or 60?
16. Hopefully
Gotcha.
not 60. That would be problematic. We're trying to be nice, running a business, lean and good, but it basically, the support we provide our clients is enough to be able to, if I lined up, let's say we serve about 65 families, households. That is the range of what we describe when you're talking about AUA. If you lined up any random 6 of them, for example, if you ask them the question and say, do you feel like Aaron Wealth has any other client? The answer should be no, 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 no. So they're getting a single family office experience. So I will hire as many people as necessary to continue that. In terms of but that also means that we're very religious in terms of the clients we take on. So we don't have that tail a lot of other IRAs do, which that goes, unfortunately, not unfortunately, whatever their business decision is more mass affluent. We're not going to do that.
Thank you for explaining. I appreciate that.
And so, can you tell us, so when you went independent, 2018, what was your book at then? I mean, you kind of took a scary leap of faith that many advisors at one point, when they want to go independent, they have to do, leaving someone like Goldman support, going on your own. What was your book like then? And obviously, you've now grown it tremendously.
Well, I was running a team at the time. We had about 1.4 billion. About $1 billion of it was direct relationships of mine. And you're darn right, it's pretty scary. Scariest time in my career, life. Next 9 months was pretty stressful. It's not. If you're going to do it on your own, it's not for the faint of heart. Which is part of the value proposition. We're trying to talk to others that are sitting in the bulge brackets and say, you don't have to do it on your own. If you're built for that, great. And I was like, you want to join us? We already know the playbook. Help us out. That's part of our recruiting strategy. And I was like, but back then, thank God for my wife and, kids and the support that was there. And again, I keep on referencing the relationships that I was betting on to kind of build that foundation for what I believed Aaron Wealth can represent. Excuse me. But yeah, it wasn't an easy decision. I love Goldman. It was a great place. Great place to run a business. So
And you know what I can say to that is whenever you start something, de novo and any type of new co, especially going from a company like Goldman, where you had, $1 billion for under management, $1 billion was money that you brought in, relationships that you brought in for yourself. When you went out on your own, were there people that had promised to go with you, but then they didn't, they didn't make the move as you
No,
expected, or did everybody make the move as they
no,
said they would?
it was a personal decision and one
Gotcha.
that was the correct one. It was right. It was time. Again, when are you going to start a business of your own? I was 39. I'm not going to do it when I'm 55. And
Right.
I was like, when you're at a certain place in life, it's time to, you got to really decide. You're going to take that risk or what are you going to do? Right. And I was like, then it was time to do so. Particularly with what I saw outside of being captive, if you will, and it's JP Morgan, Morgan Stanley, whatever. Right. If you're product oriented, you're getting paid on your product, you're captive. And back in the day, like throughout my career, that was the only choice you really had. And I believed in that. I was like, but the world changed. I could see it. And I was like, we're better positioned to be above that world, to be the replacement of these clients for their president of their single family office. That's what we do. But that makes sense. I actually don't like multifamily office at all. We call ourselves a shared family office because I think multifamily office has been bastardized a lot in the marketing world. If you ask an RA if their average client, or median client is less than $10 million, then they're not a multifamily office.
Right.
But they'll still use the phrase, right? So we call ourselves a shared family office.
And so let me ask you this: when you left Goldman, did anybody that was on your team come with you?
No, it was again a personal decision.
Gotcha.
So
Gotcha.
yeah, and went from there.
Did you?
I'm very
Did you have
grateful for the people that hired and all that.
Yeah, outside advisors lined up, or your team of the 3 other advisors you have with you, or you find them along the way?
The advisors definitely along the way. The hired 2, 3, 4, are still very much with me. But the head of my president CIO is Bill Androkakis. Was hire number 2. Georgette Condos hire number 3. All dedicated to kind of build out our team that wasn't replaceable by us also engaging Dynasty. I was like, but then from there, the advisors themselves came from JP Morgan, Citigroup, Goldman, ACO. That's the Newport Beach office. Another RIA most recently in Carmel, who's doing more business development and relationship management. So, yeah, we've just been fortunate to find really good people that want to join this journey, and we know how to transition people with that. So,
and building on that, what are some of the most valuable lessons you think you've learned throughout that transition? Do you have any advice for aspiring advisors looking to make their mark, potentially looking to go independent? What advice would you have to offer them?
don't wait. I mean, honestly, it's the biggest thing you talk about financially is you can make a lot of money, from a salary perspective or commission, but you still don't own equity. And the question I always ask those that are talking to me about potentially leaving, I said, how many in my world, right? The alternative world, well, I understand it's not, there are different segments of our business. I was asking, I was like, how many of your clients became clients of yours on salary and bonus? It's 0. I was like, it's equity. It's all equity. And I was like, so you built something. Trust me, your partner that you were associated with took their pound of flesh, and that's fine. But at some point, are you willing to make that jump, to take that risk, so you actually have equity in something, which is true all that you deserve. You build, if you're doing the right thing as an advisor, then you deserve it. So that's the advice I tell people. I was like, think about it. It's not for everybody, but I also say it's not for everybody. Totally fine. You want to make $1 million a year if you're a highly successful advisor and you're just packing away and putting your 401k, you're paying your ordinary taxes and do that for the rest of your life and you're loyal to where, fine. There's nothing wrong with that at all. I was like, you want to take it to a different level, and be able to provide your clients in a better advice and framework, then listen to what we have to provide or what the market has to provide out there.
Right.
Does that answer your question? Sorry.
Yeah.
Absolutely. And
What I was thinking about is that 2006 you joined the industry, and then 2008 happened, right? And then 2018 you open up your own company, and then 2020 happens, right?
Yeah.
So, right, it's crazy how both of them, the timing was, you know,
Look, I will tell you, if I left in 2020, I'd be working at JP Morgan probably nowadays. It would be the worst timing ever. No offense to JP Morgan. I was like, it's probably right. No, no. It would be not. Because fortunately, I left 2 years beforehand. I remember sitting with my staff, it was in March, and I said, guys, like, I don't know what this is going to look like, but you guys better be thankful you're sitting in an annuity business. And I was like, there are many of your friends and people in this country that are not. So give generously, tip generously, and go home, and we'll figure it out. Now, fortunately, I built the firm to be remote from the very beginning, so we're all set. So all of our employees in the very beginning, from when I started, had a full setup in their house or wherever they chose, and that wasn't because I thought COVID was going to happen. It was just I thought it was just more efficient, right? I was like, people have their lives just like I do. I was like, so I want them to be able to work where they're most comfortable. As long as they deliver what they're doing, I don't really care. So we were already set up. And then we hired 4 employees during COVID because ironically, and we expanded physically in our Chicago office because great deal. Nobody was doing that. Our landlord was like, great. You want to take anything down? I'm like, great. Deal they offered was amazing. And most of our staff wanted to come back in because they were younger than I was, right? Sitting in their apartment by themselves or whatever else they wanted to do it. So they were ready to go. They could go back and forth. It was all good.
So, Gary, let me ask you this: how did the name Aaron Wealth come about?
So Aaron, when we were going through the summer of figuring out like how to name the firm, I knew one thing: I didn't want to name the firm after anything related to me. Right. I always felt like that was egotistical, as well as I think just reduces the value of whatever you're building. Because if you're not there, then whatever. But I wanted something that resonated in terms of the ethics that we wanted to provide. This is a personal story. My grandfather's name is Aaron. It was named Aaron. Ironically, he hated the name Aaron. He actually changed it at 18 to Herman Aaron Hirschberg legally. Who changed his name to Herman? I don't know. But he died Herman Aaron Hirschberg. But I knew my grandfather. He was the only businessman in my family. Everybody else is medical, which are horrible business people across the board. So I learned a lot from my grandfather. I was thinking about him. And then I went, for me personally, went to my rabbi at the time. I was like, remind me, I was a theology concentration when I was at Georgetown. I was like, remind me again the stories that are associated with it. And the more I heard about it, I was like, you know what, we're not going to throw like a Bible at somebody's head. I was like, let's figure out what the story is with this. And honestly, it was like, it turned out like Aaron, as a biblical character, right, really was your first consequential advisor, first comprehensive advisor. Your most consequential character in biblical history was his brother Moses. And he did it with ethics, responsibility, humility. These are all things in which I would want the advisors that are associated with Aaron Wealth, to instill in their service to their clients. So it fit. And on top of it, I got AA, so I show up first on anybody's list any day of the week. Unless you got Aardvark Wealth Management, you don't have EB. So
right?
It's all good. Does that answer your question? Sorry.
Certainly.
Yeah, I like that story. And so, Aaron, let me ask you this. So how do you inspire your team and motivate them to really achieve their full potential? It sounds like you have some really strong core values there, integrity. Tell us a little bit more about that.
Well, I mean, I have to give, a shout out to my senior other team members that really kind of lead that framework on a regular basis. And, so we have our chief administrative officer does an amazing job. She was at Citigroup for Jen Berry is her name, but for 26 years. She just really is doing an amazing job to facilitate what you were just discussing in terms of culture. Bill, who was my CAO president, he built himself up to that as well, and a really good counterpoint to myself. We just make it very clear in terms of this is a meritocracy, as well as there are certain things that we, tolerate and certain things we don't. Like, we need to deliver to our clients a complete independence in terms of advice we give them in the best possible way. And that's our expectation. And I've been very fortunate to have hired some amazing people that I think honestly will be around for a long time. I've admired, I built it off of like some of my clients. I always looked at them, I was like, I always had these senior staff, people that were there for decades, right? Before they sold or retired or whatever it was. I said, how did you get these people to stay for decades, right? Because you go to any bulge bracket or any framework, people don't stay for decades, right? Or at least they don't partner with decades. So I learned from that, from my clients and associates, about building true long-term relationships that are based on business, but also on personal relationships that they don't interfere with each other. I'm actually very proud of the people that work with us. I believe that they are going to be here, long after I'm no longer involved.
Really cool. So what do you see as the future for Aaron Wealth? Where do you guys plan on being in 5 years from now?
I love 5 years because I do 5-year plans. So good call. We're in the midst of that, actually. And I'm talking about because this year I took an operational year, that's what I call it, of where we were focused more on, we had such significant growth and fortune of what we were offering. As like, you got to stop for a minute. And that was advice given to me a long time ago by actually somebody at Goldman, who said, look, you will fall off a cliff if you are so fortunate to have that success and you don't think about what that next foundational level is before you go to the next level. So been really focused on that this year. I think from our perspective, we're pretty fortunate that we have a lot of organic growth is huge. We have a lot of capacity to handle one client and one family at a time. I am not really in the mood to open up another physical office for a while. Although have my eye on, if I find the right person, I will, but eyes on places like Detroit, Denver, I think they're underserved markets. I was like, but if I find somebody, that sounds great, or a team. But in the meantime, just still looking at good people that may be in the wrong place or want to move from the bulge bracket otherwise with their book of business. No interest in buying books, zero. I know that's a trend in today. No interest in raising money, no interest in none of it. And I was like, I don't think we need it. I think we just continue doing what we're doing on our brand. I think it's differentiating enough. It just doesn't exist that often outside of people combining that retail side of things. I think we keep to that, we're going to do just fine. So for the next 5 years, yeah, I was like, my staff knows on plaque in front of my desk says, best made plans of mice and men, right? You gotta do this. You gotta be flexible, right? So we'll see how it goes. And COVID, right? Or who knows what's going to happen this week or whatever it may be. In the meantime, you have good people, continue that growth model, you'll be just fine. So
nice. So keep doing what you're doing, right?
And my last answer to that question is not in 5 years, because I'm still fortunately young, God willing. I was like, but it's if I can disappear, not for my clients, of course, but disappear in terms of Aaron Wealth, it has its own, and it has very much so, its own brand recognition. And I just have a plaque on the wall that says, this is the founder, but I happen to own most of the equity. That's success in my world. I'm maniacally focused about diversifying and building a brand and an offering that exists on its own. That's self-perpetuating, that has nothing to do with me. My proudest moment was back in 2019. So I left. So basically 7 months later, we closed our first 2 clients that I had never met. So Wow. They were able to close by themselves in competitive circumstances, right? That told me we had something actually real.
Right. And with your advisors, do you have junior advisors that are working their way up to be a senior advisor to join that core four, or you looking to expand to outside advisors to bring in their book?
So at the moment, we have senior advisors only. Of course, we're looking at different models. Our most recent move has been to more business development that then feeds the senior advisors that exist currently. I believe that's the right model, basically, because having an elite partnership of advisors that are national in nature, you can actually really, especially in our world, it's one client at a time, can really develop out a really great service model, as long as you have to have those salespeople, people that are there talking, making the relationships, but are not necessarily going to be doing the full-on advisor role. They, though we've built it up, have an ability to be promoted to that if they wish. That's our current model. Again, I've talked to so many people. I mean, everybody's trying different things. Who knows? I was like, it's about the quality of people you hire and best laid plans, right? I was like, but that's our current framework.
And looking at what do you see as the future of the industry, the future of wealth management and financial planning? Any trends, technology strategies that you think are really going to influence the future?
So technology-wise, I mean, of course, everybody's talking about AI, but I have my skepticism around that. I think that's, again, a marketing tool a lot of people use. I think they're focused on lead generation. Good luck, at least not in my space. Or better investment execution, also very crowded space. I think as a business owner, not necessarily as a client-facing framework, somehow using AI as a power grid to be able to develop something that allows you to have a better margin, right? What was manual doesn't have to be anymore. Operationally, I think is much more attractive. I'm always looking for that and thinking about that. Other than that, my biggest focus, and just as an observer, is like this whole massive, super aggregators, right? As they keep on going up and up and up, my theory is that ultimately they're just going to sell right back to the banks. So those of us that are not part of that have a differentiating offering, either in being top in fintech, right, which we're always looking at and trying to do, may actually benefit from that. Because I'm trying to figure out, like, where does that go ultimately?
Right.
And so let me ask you this: you had said something earlier about the trends in the industry with private equity and whatnot. Do you see that as something that's going to be more robust in the next 5 to 10 years, or how's your feeling on that?
I again, remember where I come from, right? As like, I operate and continue to operate as an ultra high net worth shared family office. And I'm very cognizant of there's very much different business, lines, right, that can do whatever it may be. So I'm just an observer to a certain extent, as interested as people are that talk to me. Any business, like, you aggregate like this and you're saying it's hot potato, right? Ultimately, you got to go somewhere. You got private, especially with private equity backing, right? Has to be liquidity. Remember, where else do you go? And the banks not yet are feeling the full pain, I would say, would happen in the next 5-10 years of the independence movement, right? Once that pain really starts being felt, then I believe that the banks who have the capital to do so will just buy them right back. Like, kind of in a probably a better way than like Goldman United Capital type of thing. Because like, people learn from that, right? I think others will come in and do the same thing. But probably learn from, just happens in Wall Street all the time, right? What you do correctly or not. That's my guess. Once again, it just, from my perspective, puts us in a better position as long as we stay true to what we're doing.
With election night being tonight, where do you see the future of the economy? I know you don't have a crystal ball, but what advice would you give to your clients or any new clients that are coming on board with you?
Right now, buckle up a little bit. We'll see who wins. And it is, historically, if you look statistically, like presidential elections or like these type of cycles actually have no real statistical bearing on market movements, right? I do believe this is actually a different cycle, just given what potentially could happen, depending on either side. It doesn't really matter. We've seen an interesting run up in markets that like defy, this potential government risk that government's the only thing in this world that can change the rules mid-game, right? But flip side, earnings have actually been pretty robust, and the Fed, God, didn't celebrate it. I mean, they did a great job. I mean, they really did. We had soft landing, inflation kind of here. That could all be changed. You have 20% tariffs across the board. That's all inflationary. You have, you have all kinds of things that happen post what happens today, and what we probably won't even know today. It will be a couple of days from now. But still, from a market perspective, we'll have to see how they present. Always forward-looking, the markets are. Always. The Fed also meets here soon, and we'll see what they cut if they do. I believe they will, at least, but not like last time. Because they're going to wait. They're going to see what ends up happening. Why wouldn't they? But from our clients, it's, again, we're long-term investors at the end of the day. I know that's, people say that, but if you focus too much on the short term, you're not going to benefit yourself. But you also need to be doing things that are aware of taxes, particularly. And that's a big differentiator for us. We're an after-tax group. That's a huge part of what we do, is always thinking state income taxes, because it's the biggest way you can lose your money. Faster than NVIDIA falling 30%.
Yeah.
Right.
Thank you.
Mm-hmm.
Yeah, interesting times ahead, that's for sure. Well, Gary, that wraps up our questions for today. Thank you so much again for joining us on the show. Yes, and sharing your insights and experiences, not only with us, but with our audience. It's been an absolute pleasure.
Thank you, guys. Really appreciate it.
And to our audience, thanks for tuning in to another episode of the What Matters podcast. Advice from Gary today, don't wait. So we'll see you next time, everyone. Until then, take care. Bye-bye.